Welcome back, everyone, to another episode of STR Loophole Show. If you're a surgeon or a high-income professional making over $1 million a year, this is what happens to your net worth if you buy one Airbnb every year for 5 years. One property becomes 5. $215,000 deployed once, $1.5 million in realized cash and tax savings, a real estate portfolio worth over $4.5 million. $535,000 comes straight off your tax bill. Permanently, the IRS never sees it. After year 2, your STR portfolio is fully self-sustaining, and you never spend money from your cash reserves to grow your portfolio. I'm going to show you exactly how that works with a real spreadsheet and a real client deal. But let me be specific about who this is for. This scenario is modeled for a physician, a surgeon, or a very high W-2 earner, making around $1 million in total income. That's our baseline. At that income level, your combined federal and state tax rate is somewhere around 42%, which means roughly $420,000 of every million you earn goes to taxes. Not invested, not compounded, gone. The question this strategy answer is, what happens when you redirect some of that into a real asset that helps you save $107,100 in taxes in year 1 alone, and then keeps paying you after that? Year 1 gets most of the attention. What almost nobody shows you is what happens in year 2 through year 5. That's what makes this a portfolio strategy, not just a one-time tax play. At $1 million income level, you are running out of easy options. Your 401k shelters 2% of what you earn. Your saving account is earning 4% today, but after taxes, that's 2.3%, and it's falling. Inflation is quietly eroding the rest. So, this strategy is one of the very few tools that actually moves the needle on $1 million income legally in the year you buy. Here's the model. Let's walk through the assumptions first, so everything that follows makes sense. Purchase price, $825,000. Down payment, 10% second home loan structure, $82,500. Total all in capital to get started. Down payment, furniture, everything else from start to finish, $215,000. Net annual cash flow per property, $65,000. Let me explain what that means. That is after mortgage, operating expenses, and everything. $65,000 ends up back in your bank account annually. This isn't a projection. This is from our client deal, $825K property purchased October 2024, listed on Airbnb January 2025. $65,000 net cash flow in the first year. No tax incentives factored in. That's the number we are using. Now the tax number, $255,000 in accelerated depreciation in year 1. Let me walk you through where that comes from. That number comes from a cost segregation study. What a cost segregation study does is go through the property component by component, flooring, landscaping, specialty equipment, and reclassify items that would normally depreciate over 27.5 years into 5-year and 15-year schedules. Combined with 100% bonus depreciation, which is back in effect for 2025, you can front load a significant portion of that depreciation into the year you acquire the property. On a $825K property, a properly executed cost segregation study typically yields 30 to 35% of the purchase price in year 1 depreciation. That is where the $255,000 comes from. At a 42% blended federal and state rate, which is typical for high earners in most states, that translates to $107,100. You never have to pay the IRS legally. So Let's state year one plainly. You put in $215,000. Tax savings returned $107,100. Annual cash flow, $65,000. That is year one. Now, let's answer the main question. Here's the section of the spreadsheet I want you to focus on. Total annual benefit by year. Year one, $172,100. That's $65,000 in cash flow plus $107,100 in tax savings. Now, the next acquisition requires $215,000 in capital. Year one benefits, $172,100. Next property needs $215K. That's a $42,900 gap, which comes from your cash reserves. You are a surgeon or a high-income professional earning $1 million a year. You have cash sitting in saving account earning almost nothing. That gap is covered by your capital that was already idle. And from year two onward, the portfolio is self-sustaining. This is a structural point that changes how you should think about this strategy. From year two forward, you're not writing another check from savings. The portfolio is funding itself from cash flow generating by properties you already own, combined with the tax savings from the new acquisition each year. Let's keep going, because this is where the model gets interesting. Year one is compelling. Year two through five, what makes this a strategy worth building? In year two, you own two properties. Combined cash flow, $130,000. Add $107,100 in tax savings. Your total benefit is $237,100. That's enough to fund year three, and you still have $22,100 remaining. In year three, you own three properties. Cash flow grows to $195,000. Add $107,100 in tax savings, and your total benefit is $302,100. That's enough to fund year four, and you still have $87,100 remaining. In year four, you own four properties. Cash flow is now $260,000. Add $107,100 in tax savings, and your total benefit is $367,100. That's enough to fund year five, and you still have $152,100 remaining. Let's talk about year five. You own five properties. Annual cash flow, $325,000 every single year, ongoing. Total tax savings over 5 years, $535,500. Total rental income over 5 years, $975,000. Total wealth created, approximately $1.5 million. From $215,000 deployed once, that's a 7 times return on the capital you actually put in. And this doesn't include property appreciation or principal pay down. Those are additional upside we haven't claimed. So let's address the elephant in the room. Is this worth the effort? Well, by year three, this portfolio is generating $195,000 a year in cash flow. And that cash flow continues regardless of whether you add another property. The tax savings are highest in the early years when depreciation is front-loaded. But the cash flow compounds and grows every year you hold. The strategy actually gets more valuable over time, not less. By the way, if you want us to run these exact numbers for your income and your state, there's a link in the description. That conversation is free and takes about 20 minutes. Now, let's keep going. I want to talk about what has to be true for these numbers to hold. Because there are conditions, and we are not going to gloss over them. The $65,000 in annual cash flow per property has to be real. You cannot buy a 3-bedroom, cookie cutter, short-term rental in any market and expect to cash flow $65K a year. You would need to purchase a large single-family home in a great location, preferably with views, which is not easy to find, especially if you have a demanding job and you can only spend a couple of hours a week looking. You need to know how to find the right property, design it to stand out, and add amenities that drive premium rates. That's what separates a property that cash flows $65K from one that generates average revenue and sits half empty. If you're not differentiating your property, it will generate average revenues, do not cash flow $65K. Every property we have sourced for clients has cash flowed a minimum of $50,000 a year. Why? Because we have the expertise and the nationwide deal flow to find these type of properties. Let's look at what this picture looks like at the end of 5 years. I also want to show you what the spreadsheet isn't capturing, because there's additional upside we haven't even counted yet. In year 5, you own 5 properties, each generating $65,000 a year in net cash flow, $325,000 a year, every year without buying another property. You have also captured $535,500 in tax savings, money that went to work in this portfolio instead of to the IRS. You received $975,000 in rental income over the 5 years, approximately $1.5 million in combined cash and tax savings realized on $215,000 of your own money deployed once. What this spreadsheet doesn't show, and it's worth naming, is what's happening inside the properties during this time. Every mortgage payment includes principal paydown. Every year, your equity position in each property grows, completely separate from cash flow, completely separate from appreciation. And at a conservative 3% annual appreciation on 5 $825K properties, you are looking at an additional roughly $120K per year in appreciation that requires nothing from you. The cash flow pays you every month. The equity builds silently in the background. Year 1 is the tax play, compelling on its own. But year 2 through 5, where this becomes a portfolio, a real, compounding, cash-flowing asset base that gets more valuable the longer you hold it. By year 5, you're not just a person who saved money on taxes 1 year. $325,000 a year in passive income, over $4.5 million in real estate assets, roughly $925,000 in net equity. So, if you're a surgeon, physician, or high-income professional watching this, here is how to think about whether this applies to you. 3 questions. 1, are you handing half of your paycheck to the IRS every April? If the answer is yes, that money is gone. It never comes back. Every year you don't act, you lose it permanently. 2, do you have or can access $200K in capital? For someone earning $1 million a year, that is roughly half of what you pay in taxes in a single year. The reframe matters. 3, can you structure your involvement to meet material participation requirements in year 1? The most common and easiest test to hit for short-term rental investors is spend more than 100 hours on the activity and no other individual spends more time on it than you do. One more thing. Bonus depreciation is at 100% is in effect now. That's a favorable legislative environment. The prudent move is to take advantage of it while it's in place, not to wait and see whether this continues. The strategy works in a 60 or 80% bonus depreciation environment too, but 100% is the optimal window, and we are in it now. If you want us, model your actual scenario, your income, your state tax, your situation. The link is in the description. It takes about 20 minutes. And if this is useful, the most valuable thing you can do is share it with the one person in your network who is making great money and writing a very large check to the IRS every year. Thank you, and see you on the next episode.